Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning and happy Friday. Today will be the 22nd of February. All right, so today will be, today will be the 22nd of December. So I'm just jumping the gun, too excited about the year end, yeah. So, before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposit. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, and as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we start our usual short-term technical analysis for today on this Friday, 22nd of December, we will have a quick recap of key events and as well as economic data releases that took shape yesterday. So yesterday was a pretty quiet day. So as we know that we're now approaching towards the tail end of the year, so shouldn't be any key economic data releases going forward into next week as well. So couple of things I want to highlight over here in terms of economic data releases. Let us start with the first one, the Conference Board Leading Index. So what is Conference Board Leading Index? So Conference Board Leading Index is actually is compiled by this private sector company called Conference Board itself. So Conference Board actually has a slew of economic data that they use to formulate a leading indicator on the US economy. That means they tend to look at, let's say, the US 10-year Treasury yield is one of them. If you go down to these are the key thing, ISM new numbers. They use the stock index S&P 500 to compile this index over here. But what's interesting, this index, right? If you look at it at this point in time, yesterday was actually pretty much very negative in terms of the year-on-year change on the LEI. So in short, so this is the Conference Board leading economic indicator. So what's, as the name shows, leading economic indicator, that means they compile a list of much more responsive economic data in US as a index. Okay, using the stock market will be one of them. Then you have the US Treasury yield will be one of them as well, and as well as ISM new orders. So they try to actually remove various lagging effect of some of the economic indicator. So what they compile leading indicator indicate to us that it's still on a downward trajectory. If you look at this blue line on my screen over here, and if you look at prior to this, three shaded columns or rows are indicating to us previous US recession. So prior to the US hitting recession, the LEI, the lead, actually shows a very sharp downward trajectory in first, as shown in the previous three recession. And very similarly, what we are seeing right now is occurring the same as well. And over here, the Conference Board actually do a breakdown by giving their own proprietary signaling system. They're looking at more of a 6-month growth rate. So over here, this is the growth rate of year on year, and this is a half yearly growth rate, 6-month growth rate annualized. And what you're seeing based on the current November level of close to -8% at this point in time, November, is signaling a recession signal already, not warning anymore. So they start to actually pin a red light recessionary signal, indicating to us that there is actually a high odds of US slipping into recession based on the proprietary, we call it a calculation by Conference Board. So with that, right, this actually kind of increase the odds that, number one, potentially we may start to see much more aggressive Fed funds rate cut into next year, coming to next year. So that also actually translate to ongoing, we call it optimism of this Fed's first Fed fund rate cut to come in as early as March. So after the release of this Conference Board latest leading economic indicator, the market pricing on the Fed funds futures, as calculated by the CME Fed Watch tool, So over here, they indicate that at this point in time, the first rate cut to come in at 83% chance in March. And we start to see it being priced in by 100% in June. All right. So there will be what I call very, very increasing dovish expectation on the market participants pricing of this Fed pivot to come in as early as March next year, and as well as potentially there'll be more cuts down the road into 2024 by looking at the there'll be a total of 6 cuts that have been priced in. So that actually also being kind of reinforced by that kind of recessionary data out from that conference board leading economic indicator. Then on the other hand, we talk about the data first, then after I share with you more about the market reaction. That this morning we have Japan inflation data coming out of the picture. So Japan inflation data also moving in line with the global kind of a global deceleration that is being seen since the second half of this year, inflation growth deceleration. So if you look at Japan at this point in time, okay, let me highlight my screen, make it bigger. Okay, so if you look at the inflation numbers, the core inflation. So this Japan has this two weird thing because they have core inflation is only excluding food. Okay, so if you exclude food, they came within market expecting. Yeah, slightly below the previous month of 2.9%. This for November, year on year 2.5%, but managed to hit consensus. Okay, if I exclude food and energy, okay, that means stripping out energy price. We know that energy prices has been falling in the last 3 months or so. It's only dipped slightly 3.8% versus 4% year on year in the previous month of October. So all in all, what we could see over here is that the inflation pressure or the inflation, we call it numbers in Japan, is not actually slipping down into a deflationary scenario like what we are seeing in potentially in China. All right, so it still remains pretty much healthy above 2% BOJ target for I think close to 20th month really coming to 2 years. So that actually sees also what I call the dollar yen didn't manage to actually see much uptick at the start of today's Asia session among the release at 7:30 a.m. All right, Singapore time. This Japan inflation data was released. So now, market reaction so far yesterday. So after that release of that very weak conference board U.S. leading economic indicator, the 10-year U.S. Treasury yield continued to plummet. So if you look at the U.S. 10-year Treasury yield over here, it continues to drop. All right, where is it now? Yeah, at this point in time. So what we could see now over here, it continues to drop much lower. After that, recovering slightly higher during the US session, up by 4 basis points to close at 3.89%, but still below the 200-day moving average. All right, so indicating to us that the trend is still down. Uh, RSI, yes, is okay. 1 second. RSI is oversold, now intending to bounce from the oversold level, but however, there is no bullish divergence as RSI also continue to clean lower low as indicated by the price action. So yes, we may see a bit of pullback or a bit of uptick in the 10-year US Treasury yield, but that may not potentially lead to a significant medium-term bullish reversal, given the fact that there is no clear we call it a medium-term downtrend exhaustion as indicated by the RSI because there's no bullish divergence, thus reducing the odds okay, of this medium-term bullish reversal. Okay, at most maybe we start to see a bit of pullback or a counter trend, kind of a counter trend rebound on this 10-year US Treasury, maybe back towards the 200-day moving average and the 20-day moving average that is acting as a resistance at 4.06%. Okay, so with that, we start to see also dollar weakness as well coming back into the picture. So dollar weakness as pretty much evidenced by the dollar closing March index closing down at negative 0.6%, still unable to break above 102.65 level. So what we could see over here is that yeah, it's going to inch down lower to test the next support at 195 and even potentially the July swing low area of 99.75. So that's the dollar index. So indicating to us that dollar weakness are still pretty much prevalent. So if you look at the performance chart, the 5-day performance chart of the dollar versus the major currency pair, so this is the 5-day rolling performance. So what you could see over here is that overall the dollar still remains on a downward trajectory. With the fact that over here is that today the dollar yen start to tick up slightly higher after the release of that CPI data in Japan at 7:50 a.m. Singapore time. But later I'll show you the technical chart of the dollar yen. It's still also no showing any signs of a we call it a short-term downtrend exhaustion as well. All right. Then over here, if we were to look at the US stock market perspective, US stock market yesterday managed to rally after prior day, we call it very weak movement due to the fact that some of us is actually looking at the zero dated time to expiry option that causing this dramatic fall off in the price action that was actually seen in Wednesday. All right. So yesterday we see a remarkable recovery on the US stock market. But however, the technical chart of the various benchmark US stock indices, the Nasdaq 100, still refused to break above the short-term resistance at 16,800 that we highlighted earlier on. That as well as very similar to the Dow Jones Industrial Average as well, despite the fact that of yesterday's short-term intraday rally. Okay, so these are the kind of the broad-based market movement that took shape yesterday, and also not forgetting gold price continue to be on the uptick, also supported by that weak CPI weak conference board leading economic indicator that translate to a lower 10-year US Treasury yield, which lead to a lower cost of holding gold. So that actually keep up the short-term momentum in gold, spot gold that was seen at the start of this week, clearing above the medium-term range of 2045. I'll highlight that later. WTI crude oil price also remains on a positive note at this point in time as well, holding above the 20-day moving average. All right. So now let us dive into the short-term technical outlook. Okay. So let us start with the benchmark US indices first. Okay. So Nasdaq 100 over here. So now let me expect my screen. All right. So what we could see over here, this is the Nasdaq 100. So Nasdaq 100 yesterday we flipped to a bearish bias. Why? Because price action starts showing signs of a bullish exhaustion in the short term, where price action break below the short term, medium term ascending channel support level that I drew from the low of 7th of December retest. Then after shaping that steep sell off on Wednesday, yesterday price action attempt to recovered, but refusing to break the 16,800 two times at the start of the US session and towards the end of the US session as well. So for sure, 16,800 will be a key pivotal resistance to watch out for to maintain this short-term bearish outlook on the Nasdaq 100. First step, a retest on this Wednesday swing low at 16,590. A breakdown below it exposes the next support at 16,430. However, only a clearance above 16,800, that means an hourly close above it, will invalidate this short-term bearish outlook on the Nasdaq 100. So this short-term bearish outlook, what I mean is that it's now doing a minor counter trend decline within a short term to medium term uptrend that is still intact. Why? Because price action is still trading above the 20-day moving average as well as the 50-day moving average, and the 20 moving average is still above the 50-day moving average, indicating to us that we are still in the process or involvement of a short to medium term uptrend phase in the Nasdaq 100. So whatever price action that we see right now, yes, we may see weakness, but at this juncture, from a technical analysis perspective, it's still a minor counter trend decline. All right, so above 16,800 will invalidate this minor counter trend decline scenario to actually revert back to a bullish impulsive phase of this short-term ongoing uptrend to test the next resistance at 6,950/6,990. Very similar on the Wall Street 30 as well, which is the Dow Jones Industrial Average, still holding below that 37,540 short-term pivotal resistance that we highlighted yesterday where we flipped to a bearish bias. So as long as this resistance holds, we will maintain that bearish bias for that potential minor counter trend decline In first step, to test yesterday's swing low area, minor swing low area at 37,170, a break below down this level exposes the next support at 36,810. Only a clearance above 37,540 and hourly close above it will invalidate this short-term minor counter trend decline scenario to restart that bullish impulsive uplift of that ongoing short-term uptrend phase to test the next resistance at 37,800 in the first step. All right, so this is 37,800, not 0.800. Okay, so that's for the major US indices. European indices using the DAX as a benchmark. So German 30 continue to trade sideways but below the 16,840 level. So the German 30 also broke down below this ascending channel support level that is in place since 27th of October low. So also increasing the odds of at least a minor counter trend decline scenario as well. So as long as 16,840 holds, still maintain that short-term bearish outlook. First support level to watch 16,650, a breakdown below it potentially exposes 16,440. Only a clearance above 16,840 and hourly close above it resumes this potential impulsive uplift sequence within this ongoing short-term uptrend towards the next resistance at 17,100 level. Okay, so that's for the German 30. Hanseng, so Hanseng continue to remains pretty much bullish at this point in time, extending this ongoing minor counter trend rebound that took shape since the low of 11th of December. So price action now clearly breaking above the 20-day moving average and now approaching the next resistance, which is the 50-day moving average that's being confluenced by the former graphical resist, we call it former swing low area of 13th of November turns into a pullback resistance at 17,160 and also confluencing with the 50% retracement of that previous down move from 16th of November all the way down to 11th of December. So the next resistance level to watch after 16,890 will be at 17,160. So we will still maintain that short-term bullish outlook on the Hong Kong 33 index, but I will shift or tighten my short-term pivotal support for today above 16,330 to be at this level over here. Okay, taking into account of yesterday's low, yesterday's Asia session, mid Asia session low at 16,550. Okay, so let me put this slightly 16,550. Okay, so 16,550 will be my Titan key short-term pivotal support for today to maintain that short-term bullish outlook for this ongoing potential short-term ongoing counter trend rebound that is still taking shape right now towards the next resistance at 17,160 after a breakout of 16,890. Only an hourly close below 16,550 will invalidate this minor counter trend rebound scenario to kickstart another choppy kind of movement to test 16,330 in the first step. A breakdown below it exposes the medium-term support level at 16,100. Okay, so still maintaining that short-term bullish outlook on the Hong Kong 33 index with a Titan key short-term pivotal support for today at 16,550. Okay, so that sums up for the benchmark stock indices. So let us go down to the FX market as per se. So FX market, let's start with the European currency first. So the euro dollar continued to push up within our expectation and hit the range resistance at 110 level that we highlighted yesterday. So it hasn't broke out above this range resistance level yet. So without breaking up this range resistance level, there could be a chance for it to come down to trade within the sideways boundary again of this short-term short-term range configuration. So it could be a kind of a ascending triangle configuration as well, because we start to see a series of higher low at this point. That means ascending triangle that took shape since the high of 15th of December. So with that, right, I don't want to tighten my short-term pivotal support level to be so close at 1.093 level. So I'm still using 1.089 level for any pullback. As long as this 1.089 level holds, still maintain that short-term bullish outlook on the euro dollar. A clearance above 110.40 level potentially sees the next resistance at 111.30. Only a breakdown below 1089 level will invalidate this bullish impulsive sequence scenario to kickstart a kind of an extension of the minor corrective decline to retest the 200-day moving average, acting also at a support at 1.0820. Okay, so still maintaining that short-term bullish outlook on the euro dollar. So now, sterling dollar. So the sterling dollar also going to inch up slightly higher, but lesser momentum than the euro dollar. So it seems to be still trapped within this symmetrical triangle configuration, minor symmetrical triangle configuration since the high of 15th of December. So yesterday it tend to push up above the 20-day moving average. Then thereafter, throughout the US session, it just go muted until now. So no change using 1.2610 as my short-term pivotal support level, looking for at least a test at the upper boundary of this minor symmetrical triangle at 127.30. Only a clearance above 127.30 potentially could see a much more bullish tone resurfacing in the sterling dollar in first step towards 128 figure resistance level, followed by 128.70. Only a hourly close below 126.10 level invalidates this short-term bullish outlook scenario for the sterling dollar to see the sterling dollar configured into a short-term corrective pullback scenario to test the next support at 124. 25.45, 125 figure, which confluence with the swing low area graphically of 8 December and 30th of December, and as well as the 200-day moving average. All right, then now Asia Pacific currency against the dollar. So let's start with the dollar yen first. So dollar yen continued to inch down lower during the US session, broke below the 20-day moving average that is within our expectations since the start of this week. So what we could see over here right now is actually fast approaching the swing low area of 14th of December. That means last Thursday swing low at 140.95. But what's interesting over here is that after the release of the latest Japanese inflation number, the RSI actually hit the oversold level. But after hitting the oversold level, the next low that's being formed, it starts to form a bullish divergence. Okay, so what it means that over here is bullish divergence right at the oversold. After hitting the oversold level, it means that the short-term decline, the minor decline, has already hit a exhaustion point. That means there is a risk of a snapback counter trend rally right now, minor, not medium term. That means, i.e., what it means over here is that where is this? Okay, pardon me. Okay, that means this short minor decline from the high of 19th of December all the way down to the low of Asia session low upon the release of that inflation data in Japan, the price action right now could do a minor counter trend rebound back towards 143.34. This graphical support level turns into a pullback resistance. Maximum, the upper limit of this descending trend line that is in place since 13th of November high, which is at 144.10. And also, if you do the Fibo retracement of this latest leg of minor downtrend move from the high of this Tuesday, it's actually close to 76.4 Fibo retracement, as well as graphically this key descending trendline support that I show you all from the high of November over here, 16th of November. So all in all, right, yes, we may a bit of anticipate a bit of minor rebound, but this minor rebound over here, this is the resistance zone to watch out for. So as long as this minor rebound didn't break above 144.10 level, potentially the dollar yen could further reinsert another leg of bearish pressure to retest 140.95 level. So all in all, still maintaining that short-term bearish outlook on the dollar yen as long as this tightened short-term pivotal resistance does not break up at 144.10 that I highlighted today. So this is the new pivotal resistance level to watch out for. Only an hourly close above 144.10 level, then potentially we may start to lead to a more pronounced minor counter trend rebound towards 145.05 level. A break above 145.05 level exposes 146.70, and 145.05 level is pretty key right now because the 20-day moving average is now confluencing at this level as well. Okay, so all in all, still maintaining that dollar yen short-term bearish outlook, notwithstanding of a potential minor counter trend push up given the fact that because of that bullish divergence that was seen in the hourly RSI, with the tightened key short-term pivotal resistance to watch for today at 144.10. Okay, so that sum up the outlook on the major FX pair. Now let's go to spot gold. So spot gold yesterday was pretty much bullish, broke above 2047, the minor range stop that is in place in 15th of December, last Friday high. And right now during the Asia session, it attempt to retest as well. And yesterday bullish breakout that we see over here does not have any signs of an bullish exhaustion. Why? Because the RSI going to shape higher high despite hitting the overbought level. So indicating to us that short-term bullish momentum still remains intact. What's the next resistance level to watch in short term? 2067/2075. Above it potentially sees a 2090 level. So what's 2090 level? Graphically is this minor congestion area over here. And if you do the Fibo extension, is actually the one-time Fibo extension of this ongoing impulsive up move. All right, also 2090. So all in all, right, these are the levels to watch. So with a tightened key short-term pivotal support level for today to maintain this ongoing short-term bullish outlook on gold XAU/USD will be at 2027. Only a breakdown below 2027 will negate this short-term bullish outlook to see another round of choppy minor corrective decline towards 2015. A breakdown below 2015 exposes the next support at 1997, which will show confluence with this upward sloping 50-day moving average. Lastly, oil. So West Texas oil going to inch higher. So if you look at the West Texas oil so far, this ongoing minor counter trend rebound that is in place since 13th of December low seems to be much intact. Very strong momentum that being exhibited on the RSI. So RSI managed to bounce pretty strongly and broke above this parallel descending trend line resistance as well during the early Asia session, what we see today. So all in all, right now, the oil price has really surpassed the 20-day moving average and a retest to this level. So what I could do over here is that for today, I will actually, given the strong momentum that is being seen, I will actually tighten the short-term pivotal support level at 72.40 for today instead. Okay, so right now 72.40. Okay, so 72.40 will be my Titan short-term pivotal support level, not resistance support level, pardon me, a bit of tongue twisting. As long as this 72.40 short-term Titan pivotal support level holds, this ongoing uh, minor counter trend rebound in WTI oil, West Texas oil may continue to see the next intermediate resistance coming in at 78.40, which is pretty key. Why? Because it's confluence with the 20-day and the downward sloping 50-day moving average. Only an hourly close below 72.40 will put this minor counter trend rebound in jeopardy to expose the next support level at 70.90. A breakdown below 70.90 takes us down for a retest at the medium term support zone of 67.55/67 figure. So overall, still maintaining that short-term bullish outlook scenario for this ongoing potential minor counter trend rebound in West Texas oil with a tightened key short-term pivotal support for today at 72.40, given we start to see a positive reading on the hourly RSI momentum indicator. All right, so what are the key events to look out for today? For today over here, there will be an all-important US PCE index. So this is another inflation gauge where it's much more favorable by the Fed to determine inflationary trend in US. So this data will be out at 9:30 p.m. Singapore time before the start of the US session. So market will be closing. Pay attention with the core PCE price index. So core PCE price index, market is expecting to come in at 3.3% year on year, below 3.5% year on year printed in October. So if you look at the trend of the core PCE price index, it's also showing deceleration of inflationary growth since the second half of this year. So any numbers that come in within market expectation, I do not expect to see a spike up in that US 10-year Treasury yield. That means, i.e., we could still continue to see ongoing dollar weakness. Except the fact that suddenly if that number came in much higher than consensus of 3.3% year on year, and it came in at around 3.8 to 4%, which was the high, which was the number seen in August. So it came in at 3.8 to 4% level. That means that could be the highest level. That could be a resurgence of inflationary pressure back in US. So that could actually start to derail this ongoing optimism of a first Fed rate cut in March. So that could see an uptick. If that scenario happens, potentially that could see an uptick in the US 10-year Treasury yield, and will also start to fit into minor dollar strength resurgence coming back into the picture as well. Okay, so with that, that pretty much sum up for today's daily dose of market insight. So next week will be a holiday week, so I'll be off for the entire of next week, and I'll be back again next year on the 2nd of January. So next week there will be no daily dose. Also, I hope that those guys who have been listening to daily dose were able you to have a great understanding of the market dynamics and as well as the market mechanics. All right. So with that, do have a great week ahead, and I wish you all a happy holiday season. And we shall speak again next year on 2nd of January. Thank you.